What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Stephen Van Meter recently did a video that claims QE, quantitative easing, is not money printing. I got so many questions about it that I wanted to make a video about whether quantitative easing is actually money printing or not. Ready? Let's dive in. Alright, I will link his video in the description below just in case you want to go watch it. In the first part, he does a great job explaining the mechanics of quantitative easing, what it actually is, and I will simplify that for you right here. You go put $10 in the bank. For you, that's an asset. It's also considered a loan. You are loaning $10 to the bank and you can get it at a certain time. You can get that money back at a certain time and you get paid a certain interest rate during the life of that loan. Now, depending on the account, usually the interest rate is low or none at all these days. And if it's a checking account or a savings account, that loan is callable at any time. It is an on-demand deposit. This means you can make them give you that $10 back at any time. So you have an asset where somebody owes you $10. For the bank, that's a liability. They owe you $10 because it's not their money, it's yours, and you can get it back whenever you'd like. So at this point, they owe you $10, and for them, that's just a liability. And the bank would not be able to stay in business very long if all they had were a bunch of liabilities. So one way or another, they have to use that to go get assets. So they take your $10 that you loaned them, and then they take that and loan it to somebody else. Remember, if you loan money to somebody, it's an asset for you and a liability for them. So they have a liability, they owe you $10. But now, since they lent that $10 to somebody else, they also have an asset because now somebody else owes them $10. That offsets their liability of owing you $10. Now, I'll pause here to note, because many of you know this already, they're not just lending out your $10. Because of fractional reserve lending, they're able to lend out 10 times, 100 times more than what you deposit. But for the sake of this discussion, that actually doesn't matter, and it doesn't make it easier to understand what's actually going on here. So we're just going to use the example of you loan $10 to them, they loan $10 to someone else. So when they take your $10 and they loan it out to somebody, it might be for a mortgage, it might be for a car loan, might be for a credit card, or they might loan that money to the government. Now, keep in mind, just like we've seen already, many of these things have multiple names. Your $10 is an asset for you. It's a liability for the bank. You can call it a loan. You can call it a deposit. When the bank takes money and loans it to the government, that's called buying a treasury. Now, the government owes $10 to the bank. They owe $10 to you. Now, I know what you're probably thinking. You're probably thinking, not exactly, because there's a secondary market for treasuries. So just because a bank buys a treasury doesn't mean that's a new loan, more money being lent to the government. And you are exactly right. Which brings us to the next part of the story. There are certain times when a bank owns too many treasuries. They are owed too much money by the government. And that's not liquid. They can't wait around 10 or 20 years for one reason or another to get those dollars back. Maybe it's because they have to give you your $10 whenever you ask for it, and you're asking for it right now, and so they need to go get $10 now. They can't wait for the government to pay them back. So what do they have to do? They have to take that treasury, which is the loan from the government to the bank, and they have to sell it to somebody else. So you lent $10 to Chase, Chase lent $10 to the government, and now Chase sells that loan to Bank of America. Now the government owes $10 to Bank of America, not Chase. Now, Bank of America had to give dollars to Chase for that, which is a good thing because now Chase has those $10 to give back to you. Simple, right? So where does QE, where does quantitative easing enter the picture here? Quantitative easing is very simply when the Federal Reserve buys treasuries from banks. So you've seen the Federal Reserve's balance sheet grow 10x over the last 12 years or so. It was at around $800 billion, whereas today it is over $8.5 trillion. This is because they buy loans. So in our last example, Chase sold their asset, the treasury, the loan that the government owed to Chase, they sold that to Bank of America. This is a net neutral transaction as far as the money supply goes because there's no new money being created here. Money just left one one bank and was added to another. But the Federal Reserve actually creates their own money out of thin air. So when Chase sells a treasury to the Federal Reserve instead of Bank of America, that's new money coming into existence that wasn't in the banking system before. All right, I want to stay on track here, so let's review. You loan $10 to Chase, that's called a deposit. They loan that $10 to the government, that's called a treasury. Then they sell that $10 loan to the Federal Reserve, that's called quantitative easing. Now, let's pause here because at this point, QE has happened. QE has taken place and we are back to square one. Chase has a liability, they owe you $10, and they have no asset to offset that liability. Now, you might be asking, well, that's clear then. Isn't this money printing? Because the system now has more dollars in it than it did before, and more than it would have otherwise if they had sold that to Bank of America instead of the Fed. And this is where I must confess I've been simplifying things a tad bit too much, because there are two categories here, and I've been calling both of them money. I've been calling both of them dollars. And technically, that is not reality. Your dollars are not the same as bank dollars. Their money is called reserves. Now, another name for these categories is base money versus broad money. Now, the technicalities of this are not important. It's just important to understand the broad picture of how this is working. Base money is banks' money is reserves. Broad money is your money, which is dollars. So in our example so far, no new dollars have been created. The Fed doesn't make dollars, they make reserves. The Fed doesn't make your money, they make the bank's money. So with this in mind, let's review, let's follow the money yet again. You loan $10 to Chase called a deposit. They loan those $10 to the federal government called a treasury. They sell that $10 loan to the Federal Reserve and they get reserves in exchange. Those reserves have been created out of thin air. So now we are seeing something that might be considered splitting hairs. No new dollars are being created by QE, but there are far more reserves in the system than there would be otherwise if the Federal Reserve was not a player in buying those assets, buying those loans off the market. So you might be wondering whether that even matters or not. Does the expansion of reserves of bank money cause the expansion of dollars of your money? Or the real question, which I think is the heart of the matter, is it inflationary or not? So here's where we get to the meat of the discussion and where we have to look at two recent examples, of which have very different outcomes. So in the first example, the year is 2008. Banks are starting to realize they've made a lot of loans that are bad loans. They can't be paid back. So let's follow the money trail. You loan $10 to Chase, called a deposit. They take that $10, they loan it to somebody else, called a mortgage. The bank now has a mortgage, but they don't want it, so they sell it to another company in exchange for some cash. Now Chase is back at square one. They've got a liability. They owe you $10, but no asset. But that company they sold the mortgage to is making a new product where they take a lot of mortgages, package them together, and then sell that whole package to many different investors. This is called a mortgage-backed security, and if that sounds confusing, it's not. Just think of a mutual fund. A mutual fund has a bunch of different stocks inside of it. You can purchase the mutual fund, and you have exposure to every single stock inside that fund. That's just what a mortgage-backed security is. It's one fund with lots of mortgages inside of it. So now, remember Chase, they need to get another asset. They just sold their mortgage, so now they buy a piece of that mortgage-backed security. This seems smart because now instead of one person owing them a whole mortgage, they have a lot of people owing them small parts of mortgages. Classic diversification, right? Spread the risk around. So, short recap. You loan $10 to Chase. They take that $10 and they loan that to many people through mortgages. You have an asset. Chase owes you $10. Chase has a liability. They owe you $10, but they also have an asset where other people owe them $10. But there's a problem. All the banks are doing this, which isn't a problem in itself other than all of the mortgages in these mortgage-backed securities are bad. This means that banks have a bunch of assets that they thought were offsetting their liabilities, and they're slowly starting to realize those assets are worthless, which means they actually don't have the assets they thought they did to offset their liabilities. And since they're bad, and since everybody else has them, there's no sucker. They can't just sell them to somebody else and get the cash that they need to go buy a good asset. Everybody's in the same boat, so nobody wants to buy these things. It's not like a treasury that Chase could just sell to Bank of America, but they still have all the liabilities. They still owe you $10. Suddenly though, they can't pay. They don't have an asset that they can liquidate in exchange for dollars to be able to pay you back. Pretty scary situation, right? Everyone wakes up, realizes the banks have loaned out your money and those loans are bad and that money has all disappeared. So the Federal Reserve steps in. The Federal Reserve makes new reserves and they buy all those assets, those bad assets from the banks at full price. They could care less whether they're bad assets. They don't care about profitability. They can print money. So the net result is that all the banks are able to sell all of these bad assets that are really worth a lot less. They can sell them at full price to the Federal Reserve and refill their coffers, get those reserves built back up to exactly what they need to offset their liabilities. They don't have to take the hit from all those asset prices falling and then not be able to repay liabilities as a result. Now pause. At this point, a bunch of assets have left the financial system by going to the Federal Reserve's balance sheet. New reserves of equal value have come back to the banks. Has any money been printed at this point? Well, there are certainly more reserves in the banking system than there would have been otherwise if everything was allowed to be priced what it was actually priced at and collapse. That is for sure. But have any new dollars been created? Has any more broad money supply been created? No. But there are certainly a lot more dollars in the system than there would be if all of the reserves would have been able to collapse, because then they wouldn't have been able to pay back those dollars. Remember, you gave Chase $10, they gave it to somebody else, and they can't get that back. They can't pay you back, which means that absent quantitative easing, absent the Federal Reserve creating a bunch of new reserves and buying all the mortgage-backed securities, all the real dollars in the system, the number of real dollars in the system would have collapsed. But because they bought all the bad assets, the base money stayed the same, the bank's reserves stayed the same, those bad assets were gotten rid of, they got reserves to recapitalize themselves. That meant the total number of dollars stayed the same instead of shrinking. So this is why QE, in that case, wasn't inflationary, because there weren't more dollars circulating in the system, there were just the same number of dollars. There were certainly a lot more dollars than there would have been if everything had collapsed, but the total supply of money didn't actually increase. So it wasn't inflationary, it just counteracted the deflation that would have otherwise been there. Now let's fast forward to 2020. The situation is very different this time. Banks are not in trouble, but in 2020, the government's appetite for borrowing suddenly explodes. They want to borrow much more than they ever have before, like a lot more. Now, here's the thing. When you loan money to Chase, does that create new money? No, it's just money leaving you and going to Chase. When you loan money to the government, does that create new money? No, it's just money going from you to the government. So normally, when the government borrows money, it's just dollars going from one person to another. It doesn't expand the total supply of dollars. Not inflationary. Not monetary expansion. But 2020 was different, and likely every year for the foreseeable future will be different as well, because the government wanted to borrow much more than anybody had the ability to lend to them. Now, one option, if you want to borrow more than anybody's willing to lend to you, one option is you can offer a much higher interest rate. And if the federal government had come out and said, hey, we're going to offer a 20% interest rate on this debt, there would have been a lot of people that would have sold some of their stocks, which have risk in them, and lent that risk free to the government at 20%, right? So they would have found a lot more money that was willing to lend to them if they had offered a higher interest rate. But there's a problem, right? They can't afford that. So who can solve this problem? You guessed it. The Fed. But how? Because by law, the Federal Reserve cannot lend directly to the government. So in order to explain how, let's follow the money trail one more time. You lend $10 to Chase, that's called a deposit. Chase then lends that $10 to the government, that's called a treasury. Chase then sells that $10 loan to the Federal Reserve, that's called QE. Now Chase gets $10 back, and the federal government owes that $10 now to the Fed. But Chase is back at square one. They've got the liability. They owe you $10. They don't have an offsetting asset, so Chase turns right back around, lends $10, the $10 they just got from the Fed, they lend that to the government once again. And then, you guessed it, they take that $10 loan, sell it to the Fed, and repeat this process over and over again to the tune of doing it about 4 trillion times. And remember, every time the Fed creates new reserves and buys an asset from a bank, that is called quantitative easing. That is QE. So what is the government then doing with all this money that they're borrowing? Are they saving it? Are they putting it away in a rainy day fund? Are they keeping it out of circulation? No. Obviously, they are spending it. Now, what happens when the government spends money? Where does it go? Well, it goes to paychecks of politicians. It goes to Social Security spending. It goes to healthcare spending. It goes to military contractors. It goes to stimulus checks. But what does that really mean? Where are all those dollars going when they go to those people or those companies or those organizations? Well, all of those dollars are going into bank accounts as a deposit. What is a deposit? That is a loan to a bank. So banks now are flush with new liabilities. And what do we know about banks when they have liability? They've got to go get an asset to offset it. So in this case, in 2020 and 2021, in the foreseeable future, QE is enabling a historic expansion of the money supply, the dollar supply, the broad money supply of real dollars in circulation. Not just the base money, not just the bank's money, not just reserves. And if we look at the broad money supply in the two examples that I've talked about, you can see that during 2009 to 2011, the broad money supply barely budged at all. This was despite the Federal Reserve's massive expansion of their own balance sheet, the massive creation of reserves and buying assets from banks. The only thing it did was recapitalize the banks. It was replacing bad assets on banks' balance sheets, basically keeping the money supply the same. It prevented a collapse in base money, which prevented a collapse in broad money. But in 2020, the story was very different. There was an unprecedented spike in broad money supply, and it kept on going in very tight correlation with the Federal Reserve's balance sheet this time, because this time quantitative easing was funding, indirectly through the banks, was funding the federal government's deficits that were in excess of the economy's ability to lend. This basically allowed the federal government to spend money into existence. And still, the Federal Reserve was only creating new reserves. They're only creating base money. But this time, QE wasn't just recapitalizing banks. It was enabling the funding of fiscal deficits. So in 2020, QE did in fact lead to money printing. So I hope by now you have a clear grasp on the situation. QE is not money printing by itself. It doesn't create dollars, it creates reserves. It doesn't create your money, it creates banks' money. But depending on fiscal policy and depending on what those reserves are used for, it can 100% enable money printing, enable dollar expansion. And when the Federal Reserve coordinates with the Treasury Department in this way to merge monetary and fiscal policy, you can use QE to print money, to spend money into existence. And that is indeed inflationary. And anyone who says otherwise has had their head buried in the sand for the last year, where pretty much every month we've seen another inflation record broken. This was a longer video than I thought it would be, but I hope it was helpful. Let me know if you have any questions in the comment section below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.